Welcome back, everybody. If you watch his channel for a while, you know that I'm a big fan of Peter Lynch and all his books, but especially One Up on Wall Street, which I honestly think is one of the best stock investing books out there. And FYI, whenever I see that book on sale, I usually just buy a couple on Amazon just to keep, and I hand them out to people. And right now I have about 5 of them sitting on my bookshelf, so maybe I'll do a giveaway of some sort soon. I don't really know. I'll figure it out and let you know. But there's one concept in that video that really helped me when I was learning about picking individual stocks. And that was the idea of grouping companies into different categories. And this is something I don't think we really talk about enough because trying to compare like a Cloudflare to an Apple or a McDonald's really makes no sense. And in One Up on Wall Street, Peter Lynch breaks down his 6 categories for stocks, how he identifies each one, what his expectations are for each one, and how it helps him choose and manage the stocks in his portfolio. So in this video, we're going to go through the 6 categories, talk about current examples of each one and when you should sell each one, and categorize the stocks in my own portfolio into one of the groups. So let's go ahead and get started. Now, the 6 categories that Peter Lynch uses are slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. So let's go ahead and get started with the slow growers. Here's what Peter Lynch says about those. Usually, these large and aging companies are expected to grow slightly faster than the gross national product. Slow growers didn't start out that way. They started out as fast growers and eventually pooped out, either because they had gone as far as they could or else they got too tired to make the most of their chances. When an industry at large slows down, as they always seem to do, most of the companies within the industry lose momentum as well. So, in general, his criteria for a slow grower is they grow slightly faster than the gross national product, so I would say anywhere between 2 to 5%, and that's depending on if you prefer to use the gross national product or the gross domestic product, but either way, it's around that 2 to 5% range. Slow growers used to be fast growers, but momentum slowed or their industry overall slowed, and a lot of times they'll pay a generous and regular dividend. Now, some examples of slow growers today, I would say would be companies like AT&T, Colgate-Palmolive, and General Mills. And we can see if we look at their growth metrics, they're all kind of around that 2 to 5% or so in terms of revenue and or earnings growth. And sooner or later, every fast-growing company or industry tends to slow down over time just with the natural evolution of business. And when you look at those examples I gave, it's funny because a lot of those were examples in the book of faster-growing companies at the time, since it was written in the 80s. So companies change over time as they mature, which we'll talk about later. But Lynch did say that he doesn't really buy slow growers, saying that you won't find a lot of 2 to 4% growers in my portfolio, because if companies aren't going anywhere fast, neither will the price of their stocks. If growth in earnings is what enriches a company, then what's the sense of wasting time on sluggards? Okay, so up next are stalwarts, and here's what he had to say about them. Stalwarts are companies such as Coca-Cola, Bristol-Myers, Procter & Gamble, and the Bell Telephone Sisters, Hershey's, Ralston Purina, and Colgate-Palmolive, which you'll remember was one of the slow growers. So a great example of it was a stalwart back in the 80s, and now it's a slow grower. These multi-billion-dollar hulks are not exactly agile climbers, but they're faster than slow growers. When you traffic in stalwarts, you're more or less in the foothills, meaning 10 to 12% annual growth in earnings. And depending on when you buy them and at what price, you can make a sizable profit in stalwarts. So in general, stalwarts are faster than slow growers, but slower than fast growers. They're solid, good growth companies with runway and some stability. And depending on when you buy and at what price, you can make a sizable profit. And he's talking about around 10 to 12% annual earnings growth. But since they're big, you shouldn't really expect a 10-bagger. And actually, Lynch goes on to say that 50% in 2 years is what you'd be delighted to get from Colgate-Palmolive in most normal situations. With the stalwarts, you have to consider taking profits more readily than you would with a Shoney's or Service Corporation International. I just want to point out that at the time, when he talks about Shoney's and Service Corporation International, he's talking about faster-growing companies. Stalwarts are stocks that I generally buy for a 30 to 50% gain, then sell and repeat the process with similar issues that haven't yet appreciated. I always keep some stalwarts in my portfolio because they offer pretty good protection during recessions and hard times. Now, obviously, this type of activity is not going to fit for everyone, right? Like, this is Peter Lynch's way of doing things, and it doesn't mean we need to mimic it exactly. Like, some people don't really like to get in and out of positions. I mean, anytime that I sell a position, someone's always telling me how I'm a trader and I'm not really an investor. So we have to just remember that everybody invests in different ways. In this case, Peter Lynch is saying, look, Once these stalwarts give me about 30 to 50%, I'm cutting them and getting a cheaper stalwart to kind of replace them with. But that may not work for you. So in a nutshell, he's saying that these aren't going to be your huge winners, but they give you stability and decent growth if you buy them at the right price. Now, some examples of stalwarts today, at least to me, would be companies like Visa, Walmart, and Costco. All right, now up next is fast growers, and here's what Lynch says about them. These are among my favorite investments. Small, aggressive, new enterprises that grow at 20 to 25% a year. If you choose wisely, this is the land of the 10 to 40 baggers and even the 200 baggers. With a small portfolio, one or two of these can make a career. A fast-growing company doesn't necessarily have to belong to a fast-growing industry, and as a matter of fact, I'd rather that it didn't. All it needs is room to expand within a slow-growing industry. So if we recap the general idea around fast growers, they're small, aggressive new enterprises that grow at 20 to 25% a year. Now, I will say a caveat to this is that some of the fast growers, even in my own portfolio, are not necessarily small enterprises. And I think that's one change that's happened is we have some very big companies growing at very fast rates. Fast growers are the land of the 10 to 40 baggers, and one or two of them can make a career. They can be in slow industries as long as they have room to grow, and actually, Peter Lynch prefers that they don't actually belong in a fast-growing industry most of the time. And he actually has passages in this book where he says, you know, when you have companies that get above the 50% kind of earnings growth, that he gets a little wary because he thinks it means that they're in a hot industry. And in general, those are things he likes to avoid. Now, I have stocks in my portfolio that absolutely meet that criteria, like NVIDIA. But again, we all have to invest in the way that we're comfortable with. Now, some examples of fast growers today would be companies like Palantir, Shopify, and yes, NVIDIA, which I know some of you will say is a cyclical, but we're going to get to that here towards the end. But now the key to investing in fast growers is understanding when they stop growing. And Peter Lynch explains more by saying that there's plenty of risk in fast growers, especially in the younger companies that tend to be overzealous and underfinanced. When an underfinanced company has headaches, it usually ends up in Chapter 11. Also, Wall Street does not look kindly on fast growers that run out of stamina and turn into slow growers. And when that happens, the stocks are beaten down accordingly. And then he goes on to say, so while the smaller fast growers risk extinction, the larger fast growers risk a rapid devaluation when they begin to falter. But for as long as they can keep it up, fast growers are the big winners in the stock market. I look for the ones that have good balance sheets and are making substantial profits. The trick is figuring out when they'll stop growing and how much to pay for the growth. Okay, next up is cyclicals, and here's what he says about those. A cyclical is a company whose sales and profits rise and fall in regular, if not completely predictable fashion. In a growth industry, business just keeps expanding, but in a cyclical industry, it expands and contracts, then expands and contracts again. He continues on with, coming out of a recession and into a vigorous economy, cyclicals flourish, and their stock prices tend to rise much faster than the prices of stalwarts. This is understandable since people buy new cars and take more airplane trips in a vigorous economy, and there's greater demand for steel, chemicals, etc. But going the other direction, the cyclicals suffer, and so do the pocketbooks of shareholders. You can lose more than 50% of your investment very quickly if you buy cyclicals in the wrong part of the cycle. And so it may be years before you'll see another upswing. And so just to recap, cyclicals are basically companies with sales and earnings that rise and fall over time. And coming out of recessions, they flourish. Going into recessions, they don't. And buying and selling at the right time really matters. And this is something that I think is worth pointing out because Lynch makes an important distinction here about cyclicals. He says cyclicals are the most misunderstood of all the types of stocks. It is here that the unwary stock picker is most easily parted from his money, and in stocks that he considers safe. Because the major cyclicals are large and well-known companies, they're naturally lumped together with the trusty stalwarts. And then he continues on, timing is everything in cyclicals, and you have to be able to detect the early signs that business is falling off or picking up. If you work in some profession that's connected to steel, aluminum, airlines, automobiles, etc., then you've got your edge. And nowhere is it more important than in this kind of investment. And if you all remember, when I talked about my reasoning for selling Caterpillar recently, it was exactly this. I saw signs of their business starting to go the other direction, and I made an assumption that it was a likely sign of things to come. Now, that may or may not happen, but that was exactly my thought process when I did that, because of course, Caterpillar is a cyclical company. Now, other than Cat, other cyclicals I would say would be companies like Ford, and obviously Delta Airlines, or basically most car companies and airline stocks. Okay, so next up is turnarounds, and here's what he says about those. Turnaround candidates have been battered, depressed, and often can barely drag themselves into Chapter 11. These aren't slow growers, these are no growers. These aren't cyclicals that rebound, these are potential fatalities. But then he continues on, turnaround stocks make up lost ground very quickly, as Chrysler, Ford, Penn Central, General Public Utilities, and numerous others have proven. The best thing about investing in successful turnarounds is that of all the categories of stocks, their ups and downs are least related to the general market. And then further on, it's not easy to compile a list of failed turnarounds except from memory because their existence is wiped out of the S&P books, the chart books, and the stockbrokers' records, and these companies are never heard from again. I could attempt to reconstruct the rather long list of failed turnarounds I wish I hadn't bought, except the mere idea of it gives me a headache. In spite of this, the occasional major success makes the turnaround business very exciting and very rewarding overall. So obviously here the risk is that you buy a turnaround and the business never really turns around. But to me, a couple examples of this would be like Macy's, and at least I would personally put Intel in this category as well. But obviously from Peter Lynch's perspective, while they do present some additional risk, turnarounds can also be big obvious winners. Okay, so lastly is asset plays, and we're not going to talk too much about these, but here's what he says. An asset play is any company that's sitting on something valuable that you know about, but that the Wall Street crowd has overlooked. Now, with so many analysts and corporate raiders snooping around, it doesn't really seem possible that there's any assets that Wall Street hasn't noticed, but believe me, there are. The asset play is where the local edge can be used to greatest advantage. And just to explain a little bit more, here's one of the examples he gave in the book. Right now, I'm holding on to Liberty Corp, an insurance company whose TV properties are worth more than the price I paid for the stock. Once you find out that the TV properties were worth $30 a share, and you saw that the stock was selling for $30 a share, well, you could take out your pocket calculator and subtract 30 from 30, and the result was the cost of your investment in a valuable insurance business, zero. Now, asset plays aren't really my own personal area of expertise, but I would imagine it would be companies like Brookfield Asset Management or maybe Howard Hughes Corporation, who are known for their asset holdings that may be worth much more in value than maybe what's reflected on paper. Now, in addition to the category definitions, Peter Lynch provides some basic guidelines on when he would sell each type of these stocks, and I think it's really interesting to go through. And I just want to reiterate that these are just a guide, right? These are just ideas that he had to say, look, these are the type of things that I'm looking at. I wouldn't take it as like a rigid checklist that you do and say, hey, it hit this item I need to sell. I would just use it as a place to get ideas, ways that he thought about it, and of course, as always, incorporate it into your own process and what you actually value. Now, for slow growers, he admits that he doesn't really have many of these, so it's not his area of expertise either, but he sells when there's been about a 30 to 50% appreciation or when fundamentals have deteriorated, such as the company's lost market share for 2 consecutive years, no new products are being developed or R&D is being cut, or maybe they've had recent acquisitions of unrelated businesses, or their balance sheet has shifted from being low debt and high cash to low cash and high debt. Now, in terms of stalwarts, the things that he looks for is if the stock price starts to outpace earnings, or if the price to earnings is too far beyond its normal range. Maybe they have new products with mixed results and others are years away, or maybe the PE of the company is higher than the rest of their peers. He also looks at things like no insiders having bought the shares within the last year, or maybe a major division that drives a lot of the revenue is becoming vulnerable, or lastly, the growth rate is slowing and future cost-cutting opportunities are limited. Now, for cyclicals, what he says is the best time is to sell towards the end of the cycle, but it's really hard to predict when that's going to be. So the next best time is when something has started to go wrong. Maybe costs have risen, existing plants are operating at full capacity and they're building more, inventories are building up and they can't get rid of them, or also falling commodity prices. Now, in terms of when to sell a fast grower, he says you really want to watch for the end of the second phase of rapid growth. And he talks about in more detail what that second phase of growth is within the book, but it's basically that stage between the startup phase and before the maturation phase where the company is experiencing rapid growth. But there are other signs as well, like the PE ratio is at absurd and illogical levels, the same store sales are down 3% in the last quarter, new store results are disappointing, or maybe top executives and employees are leaving for rival companies. Or lastly, the earnings growth projections are half of what the PE ratio is. So again, I just want to reiterate, these are just ideas, right? Like we can find plenty of examples that meet this criteria, but it wasn't a signal to sell. So again, take them with a grain of salt, take them as ways to generate ideas for yourself, but this is what he talks about. Now, in terms of turnarounds, he says basically the time to sell is after it's turned around. But other signs could be debt, which was going down, is back to rising back up again. Inventories are rising faster than sales. The PE ratio is inflated compared to earnings projections, or they're dependent on one customer who is maybe about to experience a slowdown. And then lastly, the when to sell an asset play. Sign number one is if there's a takeover or bidding war as people have figured out the asset value. But other signs can be maybe management is planning to issue new shares to diversify, or an asset or division sales come in lower than expected in terms of price, or maybe tax changes are impacting the tax advantages of the asset at play. Or lastly, institutional ownership has risen dramatically. So to wrap up, just for fun, let's take a look at where I would put each of my own stocks in terms of Peter Lynch's categories. Now, in terms of slow growers, I would actually put McDonald's here, although you could maybe argue it's on the borderline of stalwart, but I think if you really look at their growth kind of history and projections in terms of revenue and earnings per share, slow grower is probably where it needs to be. Now, in terms of stalwarts, I would put Visa, Apple, American Express, Taiwan Semi, and MSCI in that group. And I know some of you have questions right now, but just hold off and we'll get to it. And then lastly, fast growers, because I only think I have 3 categories in my portfolio. Fast growers, I have Cloudflare, Nvidia, Google, Meta, and Amazon. And now I know some of you are going to look at this and be like, hey, wait a minute, Nvidia and TSM are semiconductor stocks, and semiconductor stocks are cyclical. And we know this because everyone on Twitter and online talks about how semiconductor stocks are cyclical. And so, yes, the first thing to know is that there's definitely some subjectivity in deciding what category something's in. Like, for example, while I agree the semiconductor industry broadly is cyclical because we're seeing that cyclicality right now for non-AI related chips, Nvidia and TSM are in a fast growth stage because of AI, and Nvidia for sure, and I would say TSM looks more like a stalwart with its consistent demand meeting their constrained supply. Now, will this change over time? Yeah, probably, of course. At some point, these industries slow down. At some point, these companies slow down. We talked about that at the jump, but that's why we have to kind of use our own judgment as to where we think these companies are at, because a company can change its category over time, and quite frankly, they can be in multiple categories at the same time. So that's something that we have to decide as individuals in terms of where we think these companies are in based on what's going on in their industry, their own individual company, and their business life cycle. And I think this passage from the book really sums it up well. Companies don't stay in the same category forever. Over my years of watching stocks, I've seen hundreds of them starting out fitting one description and end up fitting another. Fast growers can lead exciting lives, and then they burn out, just as humans can. They can't maintain double-digit growth forever, and sooner or later, they exhaust themselves and settle down into the comfortable single digits of sluggards and stalwarts. From Dow Chemical to Tampa Electric, the high flyers of one decade become the groundhogs of the next. Stop and Shop went from being a slow grower to a fast grower, an unusual reversal. Advanced Micro Devices and Texas Instruments, once championed fast growers, are now regarded as cyclicals. Cyclicals with serious financial problems collapse and then reemerge as turnarounds. And he continues on, growth companies that can't stand prosperity foolishly diversify, fall out of favor, which makes them into turnarounds. A fast grower such as Holiday Inn inevitably slows down and the stock is depressed until some smart investors realize that it owns so much real estate that it's a great asset play. And companies such as Penn Central may fall into 2 categories at once, and Disney, over its lifetime, has been in every major category. Years ago, it had the momentum of a fast grower, which led to the size and financial strength of a stalwart, followed by a period when all those great assets in real estate, old movies, and cartoons were significant. Then, in the mid-1980s, when Disney was in a slump, you could have bought it as a turnaround. And I think one of the most obvious examples of this is when you look at big tech and where I put it in these categories, like Google, Meta, Amazon, they're all in the fast grower list, even though they're some of the biggest companies in the market. And I think if you looked maybe a couple years ago, you wouldn't have put them there. You would have maybe put them in the stalwarts, maybe even the turnarounds, depending on which company you were looking at. And so these things change over time. And it's one of those things where we shouldn't take everything as like this real rigid framework. It's one of those things to help us get an idea of what we're looking at for each company and maybe what we should expect. But I think the biggest advantage is it gets us in the process of saying, okay, where is this company in its life cycle and what should I expect from it as an investment? Because depending on kind of where it lives in these categories, your expectations should probably be a little different. So why does any of this matter? Now, as you can see, the main idea here is that each company is in its own business life cycle and you have to evaluate each one accordingly. If you evaluate a Coca-Cola the same way you evaluate a Palantir, it's not likely going to make a lot of sense. And so you have to understand what it is in terms of criteria that you're looking for. And then once you find those stocks, are they in categories that make sense for what you're trying to accomplish and maybe even what your strengths are? And then do you understand the signs in terms of buying and selling that make sense for each one? Because they're likely to be different. Now, One Up on Wall Street is a book that really influenced the way that I looked at stocks, but it also tackled some common investing myths that aren't really what they seem. And if you want to see me go over 4 of those that we hear all the time, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.